Hi everyone, and welcome to the next episode of the HeelanHub podcast, the show for small business owners. I'm Dan Heelan. On today's show, it is just me today talking to you about the tax funnel. So bear with me. If you've not heard of this, I'm not surprised. It's an internal framework we use to help business owners save tax. And it's good to kind of talk about it. I think sometimes it works quite well in a video format, so I can kind of draw it for you. But I'm going to do my best on the podcast to explain it. Now, we have been throwing these episodes up on a side YouTube channel. So if you go and search in YouTube, the HeelanHub podcast, it should pop up. There's a small delay from when this show will arrive, normally a few days to a week. Actually, at the moment, we're looking to shortcut that. So you'll be able to see it up there. And maybe we'll try and show it a little bit more on screen so you can see where we're going from. So if you are there on YouTube now watching, welcome. For everybody else, I'm going to do my absolute best to explain it to you. So let's get into it. So the tax funnel, what is it? Well, it's a weird concept in that when we're looking at an owner's sort of tax situation and thinking about how many different ways we could save money, it's the idea is that, in my head at least, this is how I've always thought of it. I've thought of it like, if you imagine if you're on a podcast now, if you're on the YouTube channel, we'll show you briefly so you can kind of get a bit of an idea, but you'd have almost an inversed triangle. So an upside down triangle is probably the easiest way to describe it. And the kind of framework is free, cheap and efficient. And we take you through a bit of a journey. So if you imagine it's like an upside down triangle, we've got free at the top, the next layer is cheap, and then the one down is efficient. And as we move down the funnel, things become a bit harder, a bit more technical, and a bit more less tax efficient, I guess. Now, what I also like to picture is down the right-hand side of it, if you imagine the funnel from left to right for a moment, the stuff towards the left is the easy stuff, the stuff you're likely to gonna be able to go and research yourself, general knowledge, the fact you're listening to this podcast or you're watching videos, you're going to be able to find out these kind of things. And then as you move towards the right of the funnel, again, there's maybe less known pieces of information or they start to get more complex. And then there's a sort of a bar. When I draw this as a diagram, I always draw this bar down the right-hand side. And that bar is this point where we indicate, look, this is where the really clever stuff is, maybe technical, maybe not quite as known. And also sometimes the more area for challenge potentially. So maybe there's a little bit of risk that the revenue might look at it and want you to justify it in an investigation scenario. So, you only go in there when you really need to, really. But what you never go past is, if you imagine on the right hand side of this upside down triangle, there's a massive red line, and that red line is a do not cross. That's the offshore tax schemes, that's the Jimmy Carr car schemes, all these things, these film partnerships people did years ago, loan schemes, anything that sounds too good to be true, because what has been proven time and time again over the last 18 years of me being involved in this industry is that if it's too good to be true, it'll end up being proved to be too good to be true. Now, what also happens in these situations is very frequently they don't get proven to not be true until far later down the line. So at the moment, for example, in the property world, there's a couple of big companies that have made lots and lots of money over the years selling schemes to bring properties into a supposed limited company structure that works really tax efficiently. They're now in the spotlight with HMRC, which means they're inevitably, the clients are going to be in problems, the company's going to be in problems, and it's going to be a mess for everybody. So I don't like to go down that right hand side. You'll never hear me talk about anything the other side of there. I believe personally that tax is a success fee. You have heard me probably, if you've been listening to the podcast for a while, talk about this. And I think that everybody should pay tax for a functioning society, but because it is a fee, nobody wants to be paying any more of a fee than we should and that we need to. And that's the biggest thing with tax and business owners is, if you imagine somebody who's employed, generally they're going to pay the right amount of tax. It's actually, the rules are still relatively complex, but the way it's calculated in their pay slip means, okay, if the tax code's wrong or the tax code doesn't reflect their actual situation, they will get stung with a tax bill later. But it's actually relatively rare in the grand scheme of people, everybody who's on PAYE, as it's known, on the payroll. And again, there will be people screaming at the mic in the earphones going, look, I've had all these problems. I literally had it today, actually. I got two people in my WhatsApp, both well known to me, and they're asking me about tax coding problems. And they've been asked, one's asked for $3,000, one's asked for $4,000, both of which the revenue is completely correct in asking for it because their tax code was wrong. It should never have been what it was. That does occur. So that aside, somebody in employment, it's pretty black or white, will pay the right amount of tax. Even in this situation, it might be that they're paying it later, but they will pay it. So as frustrating as that is, because obviously you get your pay, you think you can spend it, you shouldn't expect that there is more tax. Then when you're in employment, it's pretty good. What happens when you're a business owner, so when you're self-employed or you're an owner of a limited company, is the tax law is so wide and there's so many things you could possibly deduct. It's 22,000 pages plus the UK tax law, plus all the guidance, tax law cases, all the rest of it that kind of overlays this. How are you meant to know? So the only thing you can do really is educate yourself and hopefully work with professionals that can help you navigate this. And when we're thinking about the actual tax funnel, this is the type of thing that we're talking about, is to bring us into a world where actually what we're looking at is on the tax funnel, whereabouts can we save some money? Where is it going to be where we can look at it and go, we can win, basically, and make sure that you're only paying the right amount of tax. And that's where we use the tax funnel to make sure that actually you're claiming everything you should be able to claim, to make sure your tax bill is only what it absolutely needs to be. So if we start at the top, then let's start talking about let's use a scenario and take you through it. So I'm going to use a limited company owner because that's the majority of people that get a really good success at this. It absolutely works though if you're self-employed, and many of the things we're going to talk about also apply in a self-employed scenario, but we'll just use this one as an example. And you would have heard me say that while we're on kind of catchphrases, I've got this thing about the fact that anything where it's tax is concerned, anything that's a you problem, we want to try and make a company or a business problem if you're a sole trader. So it's not easy to do, because I'm not saying that you should suddenly be putting all your personal expenditure through your limited company or through your business, because that's not allowable. The basic rules are that a piece of expenditure needs to be wholly and exclusively for the use of that business to be tax deductible, right? So it's not a case that you can just suddenly start sticking this stuff through. But there will be things that you're paying for personally right now that are actually a business expense when you think about it, that you might not be putting through. And that's what we're talking about in some of these areas. Or actually, as we're going to see with the first example I'm going to use in the free section of the tax funnel, is there's something where you're allowed to use it personally and it's fine. So let's start there. So when we look at the free section, the top, imagine again, if you're on a podcast, there's an upside down triangle, so it's the biggest base, and that's the free stuff. And this one, you can get a lot of quick wins by just doing your research online with this. If you're working with an accountant, many of them will be doing these things. But you'd be surprised the amount, because accountants vary wildly in terms of their knowledge and what you're actually paying them to do. You'll probably I'd find nearly every set of accounts I look at is missing something that I know from this free section. You might find that is too. So have a look at what you're claiming. Think about some of the things I'm going to talk about. But the first thing that's a really obvious good example is your mobile phone. So if you're currently paying for your mobile phone, and you're in business, if you're a limited company, your company can provide a phone to you as an employee of that limited company, tax-free. So not only, if you imagine at the moment, you've paid corporation tax and you've paid dividend tax on that, probably if you've taken it out, or you'd have paid sort of the normal income salary taxes that you would have paid. Either way, you paid tax twice to get this phone, to be able to pay the direct debit for the phone. Now, if the company contracts, and this is a point I'll come back to, but let's say you get the contract in the company name and it gives you the phone, there's an exemption that says if it's one phone, you can use it as much as you want personally. It doesn't matter. It's fine. There's an exemption. There's no income tax on it. And not only that, the company in providing it to you gets a tax deduction itself. So it's gone from paying 2 lots of tax, you effectively have paid 2 lots of tax, the company once and you a second time, to no tax for you and the company getting a tax deduction, and if you're VAT registered, very likely the VAT back. So you can see it's a massive difference in result, and you do that over a year, it's a big deal. I think I recently did a short or a reel, whatever you want to call it, on the various social media platforms, talking about the new iPhone 17 that's out and how you could do that. And it's the same concept, the company buying the iPhone and supplying it to you is going to be a massively different situation than you using £1,000 out of your own bank account that's had those double taxation most likely put in place. So it's big. Now, I said about contracting. If you're doing a limited company, it's really, really important that you go and get a business contract and it's in the company name, because otherwise some of these things fail, particularly the VAT. So just bear that in mind. It should be a contract between you and the company. If you're a sole trader, obviously it doesn't make any difference. You are the person. But what happens with the sole trader is actually I would put a phone in the cheap bucket rather than the free bucket. I'd move it down a tier. And the reason that is because without going too deep on phones, you'd have to disallow any private use of that phone. So that might mean that if it's a £1,200 iPhone and you had a 25% personal use, you used it 25% of the time personally, you could only claim $900 on your tax return. So it becomes cheap rather than free, as it were. Obviously, in real terms, on all these things, none of it's actually free because you've still got to pay for the actual iPhone itself. But it does give you an idea of the fact that it's going to be it's going to feel a lot freer if the tax office is paying quite a chunk out of the tax bill for you. So mobile phones is a good one. If we were then looking at an owner, so an owner I did this with the other day, one of our clients was in for a year end, we were talking about pensions. You can make an employer's pension contribution through the limited company. That was free. Same idea. You're not touching any of the money personally, so there's no income tax, and the company's getting a tax deduction. So that one's quite big. So that's a big one. There's something known as trivial benefits. And I think if you go back a few episodes, maybe 5, 6, we talk about pay strategies, and we were talking about, this idea of using some of these things. But trivial benefits is one where you can actually gift yourself certain items at £50 out of a limited company. There is lots of criteria to meet, but it's really quite useful. There's canteen expenses. That's quite a big one, where if you're operating a home office or you've actually got an office, so like in our office here, we'll have a canteen, we'll have tea, coffee, bananas, crisps, biscuits, that kind of stuff. That can all go through. So you, as a one-person limited company owner, if you're maintaining a home canteen, you might have your coffee machine, your coffee maker, again, your bananas. Maybe you supply a bit of rolls and some ham, so subsidised canteen and your lunch. Generally, that's going to be okay at a reasonable scale. Again, I'm not going to delve too deep into that, but when we're thinking about the tax funnel in this kind of lens, that's where we're still on free stuff. Because again, you're taking that expenditure that you're paying for into the company's name and the company paying for it. And because of the exemptions that exist, we're able to do it. So again, we're not talking about, suddenly making something that was personal business out of thin air. We're talking about using the exemptions that exist to shift it from personal to the company in this example. So, and some of these work with being a sole trader or a partner in a business, and some don't. But in this example, we're talking mainly about limited companies. But if this starts to think, is this for a sole trader? Ask away somewhere, maybe come into the YouTube channel and ask in the comments, and we can talk about which ones apply and which ones don't. I'll try and drop in as we're talking. So then when we move down, so we got that, and then we've got annual functions. That's a limited company one. So maybe you want to go out for a Christmas meal. There's £150 a head that you're able to do that tax-free, income tax-free. And again, it gets you a deduction for the corporation tax, so it's good. And you sort of move, and I would say like the canteen, for example, I said to you about moving left to right. I suspect if you speak to many accountants, they might not even entertain the canteen one. So that would be in that bar down the right-hand side I'm talking about. I always picture it as a green bar just before the red bar. The red bar is the one we don't cross. The green bar is slightly more open to challenge. You have to be slightly more sensible, and it's slightly less well known. And some accountants, just out of pure principle, don't like it. But it's absolutely there. There's an HMRC manual talking about it. There's a tax law talking about it. There's just very set rules and criteria, as always with tax, to make sure that you fit. I'm talking very generally in this, but there's absolutely something that can be done in the right circumstances. So they're the kind of like some really obvious free ones that we were talking to a client about. And then we moved into the cheap ones. Now the cheap ones is where there's a tax deduction most likely, but there's also maybe a consequence, or there's not a full tax deduction. So a good example being low benefiting kind cars. Now what I mean by that is your electric cars, your Teslas and the like, have very good allowances when you buy new and unused ones up front that allow you to write pretty much the whole of the cost of the car off against your profits, which massively reduces your tax bill if you buy them in the right way and new and unused. Even if you don't, but you needed the car anyway, it can be a good way to provide it to you. Same deal, company buys it and contracts for the actual car, whether that's a lease, whether that's a bought, to get the 100% relief you're normally buying, but otherwise you're renting. And what you do is the company gives it to you and you pay a benefit on kind on that. Now, what that means is you get personally taxed on it, but the rates are a very small percentage of the list price. So, if it was £100,000 car, the list price might be, say, 3%. You're not going to pay a lot of tax on that. The company pays some tax as well. So, and again, that's probably a whole other episode, but just know that it's cheap. If you were, it's better than you drawing all the money from the company and buying it, or having you personally fund the lease rental. It's normally going to end up better. Again, do your research, check your circumstances. Might not be true in everyone, but generally I'm talking about. So in the example I gave where we did this with a client, they were looking, I think, at a new electric Beamer, a BMW, and it's going to work out quite well for them. So like, okay, I do need to replace the car. And again, I've spoke about this a lot. Where it's tax deductible doesn't mean it's free. So if the car costs 20 grand, it's not like you're saving 20 grand of tax. You're probably saving 25% of 20 grand. So just bear that in mind. But if you needed the car anyway, and you were going to pay for it personally, this is this idea of it becoming not a you problem, a company problem, and being quite tax efficient, because the company will get a tax deduction. So although you'll be paying some light personal tax on that benefit in kind, and the company will pay a little bit, you'll also get a tax deduction, weirdly, on the company's tax bill for providing it to you and the actual cost of providing it to you. So again, you could do loads of maths on this, but it generally works out quite cheap. Hence, it's in the cheap box. Now, there's some caveats to this with cars that's probably for another show, but they are eking those rates up. They have historically done this. They sort of trap you. They give you a nice introductory rate and then they bump it up 1% every year until it becomes quite expensive. But most car owners don't tend to have cars for very long time, so it's not normally too big a deal, but it's just something to know about. And just as a side note, if electric's not your thing, some hybrids are quite good. So for example, I have a hybrid Land Rover, and actually that's not the end of the world given the tax rates I would pay if I bought the Land Rover personally. So, it's worth looking at those kind of things. And then other things in this category will be things like medical insurance. So quite often it's cheaper to get a company policy for medical insurance than it is to get a private policy. So what people often do is, although the company ends up providing it to you and it's a taxable benefit, so same situation as a car, companies paying some national insurance on it, basically. I know I refer to it as tax, but it's technically national insurance, and you're going to pay some income tax on it. The company's still getting a tax deduction on providing it to you, and the national insurance it's paying on your behalf. So it works out relatively good when you factor all of that in. And if we flick back to the free level for a moment, there is also something called relevant life insurance. If you're looking for life insurance, there's a policy that means actually it's benefit in kind free, so you can put that one in the free bucket as well. So cheap ones, low benefit in kind cars, medical insurance. In the example, I was talking to a client. We're also looking at things like using basic rate dividends, so paying yourself dividends instead of salary, and there's a split to this. And you could say, well, isn't that just tax efficient? So doesn't it feel better in the efficient bucket? But I think I would class that as cheap, because I call that cheap money. So using your personal allowance of, say, 12.5k. We've done other episodes about talking about how to pay yourself from a limited company, quite a few of them actually. Just go back a few episodes and you'll probably find them. But you'll end up then having an amount up to around 50k a year, where the dividends are only like 8.75%. So it's pretty cheap. You'd have already paid corporation tax, but as an overall tax rate, you normally want to maximise then. So like when we're doing planning for people, we'd want to be going, okay, so what else have we got tax band wise to play with? And we make sure we maximise those. They're in the cheap box. And then we'd be looking at things when we're moving towards the right hand side, towards that green, what's in the margins. We might talk to you about, okay, in the example I did with a client, it was like, okay, how many kids you got? What ages are they? Oh, actually, we've got a 17 and 18-year-old that are in college and university, and the owners keep putting their hand in their pocket to pay for them to do stuff. But actually, they've got skills that mean that our client could employ them and pay them properly. Their sons, the two sons in this case, the two sons have both got full personal allowances in the UK. So the first 12.5 grand-ish is all tax-free. So they're not paying any tax. And the company is getting a full tax deduction on the wages it pays them. Now, this one's got a lot of caveats and ifs and buts, because you've got to make sure that the wages you're paying are reasonable for the what they're actually doing for the company, if you really want to secure the tax deduction and all this kind of stuff. But if you just imagine, in principle, if it's possible to pay about 12 grand a year and they had no other employment, works for them, works for the company, stops it being a you problem, you putting your hand in your pocket when you've already paid corporation tax, dividend tax, income tax, whatever you want to call it, to give them the money to live on while they're at uni or whatever. So that one is massive potential in there. But I'd say that's in the margins. You need certain things, slightly more trickier to set up, because you're probably going to need a payroll system, there's stuff going on, and things like that. But that's a very common one. I would also put in the cheap box entertainment. So if you're out and about having dinner and you're actually discussing business, it's likely that the company could pay for that. Again, criteria available, so you need to make a note of who you spoke to, what you were talking about, that kind of stuff, if it was ever to be inspected. I find in all of the 18 odd years of doing this, I've never seen the revenue ask, this is HMRC, ask for that log. But in theory, I think if it was an exceptional amount and it looked like you were just spending out every single night on whatever, they might, they definitely could ask. I think in investigations, they tend to just look at the overall picture, and they're humans. They want to look, if it looks stupid, they're going to ask you to justify it, basically. So you should keep a log of that. But entertaining, again, you're moving it from being a you problem to the company problem. Now, the company doesn't get any tax relief, but it's not a you problem, because it doesn't go down as your earnings. So you haven't paid anything. So that's you out at a business meal, taking a client or a potential client out for a business meal, that kind of thing, definitely falls in the cheap box, because it's not free, but it is definitely cheap. So that's really good. So there's some ideas in that bit. And then we move down into the efficient part. And this is really where we're looking to squeeze things out, like, have we got a significant other that could own some shares in the company? Can we split some income out to them, maybe by paying them a dividend instead of you, because you're already near 50k? Is there a way of structuring the shares? And sort of spoiler, there is normally a way of structuring it so that you could pay different dividends to different people within a margin. So that happens. Do we want to tweak the salary and dividends split that we're doing? Do we maybe want to use what's known as the director's loan account to actually loan some money for a short period? That can work over a couple of tax years, can work quite well, but there's very strict limits to that one. So we really, when you get to the bottom, you are literally, this is why I like to picture as a funnel, you're literally squeezing the last drops out of everything you can, and there's less done in here. And you'd argue it's probably more green that's in there in terms of you're quite often operating towards the more riskier end of the margin. And I use risky light because you're not breaking any rules, but it might be one of those areas that's less obvious than just paying for a mobile phone, which is pretty straightforward and the criteria are relatively straightforward. So that gives you an idea of how this funnel kind of works. So just think, firstly, is anything a you problem that could be a company problem? And then you're going to work through the funnel and just think, what's the free stuff? And again, most of that you'd be able to pick up from listening, watching on YouTube. If you go to our main channel at Heelan Associates, you'll find 400 odd videos talking about a lot of the free stuff that's in there. And other accountants will do this stuff as well. It's the thing that a lot of them know about. But I bet you, there's loads of you listening to this that have never heard of trivial benefits. I think it's becoming more and more popular, but going back 5 odd years ago, it was kind of like a really shadowy topic that nobody knew about. So go and check those out, and then go down, and you can get that feel for it. And then you're into the efficient stuff. And I think when you're in the efficient area, that's where you tend to have decent accountants, tax planners, tax advisors, maybe if you're really in that world, that are just making sure that all that's sorted out for you. So you're really saving all of the final bits. Maybe I often think, if I know we talked about pensions up in the free section, but I think sometimes personal pension payments can end up in the efficiency section because they're not free, they're not cheap, but they can actually, the way they interact with your tax brackets can mean in certain situations that they would work quite well. As a sole trader, they might be your only option, or an employee, even as an employed person. So there's a few things, unfortunately, the free and the cheap parts as an employed person look very, very shallow. So whilst they do pay the right amount of tax, there's not a lot they can do in their circumstances. Sometimes there's things like marriage transfers that are possible and a few other little things, and extra mileage claims, but not a lot. So that's kind of how the tax funnel would work. So hopefully it's just giving you some food for thought for thinking, what's a you problem that could be a company problem or could be a business problem if you're a sole trade, and then go do some research on it. So hopefully you've enjoyed that little ramble through the tax funnel framework. And if you have enjoyed today's show, make sure to subscribe via your favourite app so you don't miss an episode. You can also review us on those apps, which is really great for our visibility. So if you get a few moments, I'd love it if you could just drop us a review on there, even a couple of thoughts if you can. The stars are always appreciated, obviously, but if there's the option to put some words in, it's nice to read. For more business insight and tax tips, be sure to connect with me and my great team on all the social media channels, including, of course, LinkedIn, Insta, YouTube, Facebook, Twitter, and TikTok's been quite popular recently. So I've been having fun doing that and interacting with you all on there. So if you're on there, go drop us a follow. You can also sign up to our 2-weekly HeelanHub Herald, which is an email which contains even more business and insight and tax tips direct to your inbox. And you can do that if you go to heelanassociates.co.uk. Scroll around for literally a few seconds, you'll get a pop-up and you can do that. If you're looking to get into the world of cloud accounting because the Making Tax Digital program's coming up, or you're looking to start a new company, if you go to heelanassociates.co.uk/0, all lowercase, for some reason that's important, you will get to a really good deal for zero. At the time of recording this, I think it's about 95% off for 6 months. It's really, really good. Could change, but that's where it is now. So go get it. It might be time limited. And if you do want to get in touch about the podcast, you can do so directly at info@heelanassociates.co.uk. If you've got any questions, I'd actually recommend popping onto the HeelanHub YouTube channel and sticking it in the comments there. I'll normally catch up at least once a week, if not more, to go through those and see what we can answer generically and point you in the right direction. That's it. Have a profitable and tax efficient couple of weeks, and I'll see you in the next one.